on board the management of Dixon Technologies. They've just got into a JV. So let's try and understand what really is the position A on this JV, and of course, how are things looking like overall with the business. Saurabh Gupta, the CFO at Dixon Technologies, on the show with us right now. Saurabh, hi, good morning. Good to have you on the show. Tell us all about this new JV with Japan's Rexxam. You're going to manufacture printed circuit boards for ACs. What's the rationale behind this JV? What kind of revenue potential does it bring on the table for you?
Yeah, so Rexxam is a Japanese company. They are a design and technology partner to Daikin, which is one of the largest air conditioning companies in the world. So they clearly they have strength in PCBA designing for the inverter control boards. We were already doing some business with them for the last 6-7 years, but now they wanted to increase their commitments and they want to make India as a manufacturing hub for its potential customers, but both domestic and global markets. So we are a beneficiary under the PLI. We recently got an approval under the PLI, and this company that we have formed will be 60% owned by Rexxam and 40% owned by Dixon. Clearly, what strengths? So our strengths is, of course, we have an excellent track record of manufacturing. They bring the design and technology. So it's a venture clearly which is best positioned to be a key player in its space, and it will strengthen India's electronic sector and also achieve India's government vision of Atmanirbhar Bharat. And if you look at the overall, we see Rexxam as a strategic partner because clearly we share our core values of quality, engineering, customer satisfaction, innovation. And clearly, if you look at, there's immense potential to continuously build in more and more capabilities as we go along in this JV. As far as the revenue potential is concerned, next couple of years, we think that the JV should start generating 350 to 400 crore revenues with a very strong EBITDA margins of 7 to 8%. And the return ratios will be very strong because there is no working capital deployment. And basically, and only the capexes that we need to do in this JV would be somewhere around 50 crores over the next 5 years. And we also get an incentive from the government of around 37-38 crores. So clearly, it's looking very promising, and we are really excited about this vertical.
Indeed. But tell me, globally, is there still a concern of semiconductor chip shortage, or things easing out or smoothening out?
No, things have not been easing out. Globally, still there are concerns in semiconductor. And though there have been some softening of commodity prices overall, there has been some correction in the sea freights. But overall, yes, the shortage on semiconductors continues. And my sense, it will take some more time, a couple of more quarters for effectively it to stabilize.
Saurabh, the other thing also is the commodity price inflation. How is it that you're coping with it at your end? And is it a given that the cost pressures are going to be passed on to the consumers by way of price hikes?
Yeah, so we have taken price hikes. So basically, the two business models that we follow, almost 75-80% of the business, which we call a prescriptive business, there the understanding with the customer is that it is immediately passed on. So Dixon doesn't take any currency or commodity risk. But yes, we have been in some kind of a commodity super cycle, and it impacts our ODM business, which is predominantly the lighting and washing machine business. So the way the margins have impacted in the earlier quarters, and it continues to impact us. However, we have taken the price increases, we have passed it on. But yeah, still some portion is still left to be passed on, which we are hoping that we'll be able to pass on in Q4. So since there is continuous increase in prices, so yeah, there's some pricing which is still left to be passed on.
Saurabh, I guess that a lot of people are wary of looking forward even beyond 3 months, considering the kind of disruptions that we've seen. We've had 2 summers that have gotten heavily disrupted, right? So what are you anticipating? How are you planning the business? Because this is usually a busy season for you. What is the order book looking like?
So as of now, the order book is looking okay. I would not say it is great, but it is looking okay. And one has to wait and watch and be cautiously hopeful that this Omicron does not impact the demand. As of now, it doesn't look like, because it's still milder and people are doing the regular stuff. But yeah, so my sense is it should be fine. The order book should be fine. The demand is there, and whatever visibility we have from our customers, it looks okay.
Saurabh, the other thing, of course, is your management of inventories and also the amount of stock that you keep, right? And overall supply chain management. I'm guessing that has changed dramatically over the course of the pandemic. Has that affected your cost structures at all? Have you had to move certain ways in which you're doing things?
Yeah, so you are right. Actually, we took some calls to basically buy certain inventory of some critical components in advance because there was shortage, and we had an order book to that effect. So that gave us an advantage, that put us in a strategic position as compared to our competitors. So working capital intensity has gone up in the ODM business. But clearly, as a company, there's always a huge amount of focus on the working capital management, and we're continuously working on bringing it down. We are hopeful that with Q4 and Q1, it should start coming down because clearly I'm seeing that the prices of some of these critical components that are used in the ODM business are kind of softening down. So those should revert back to the normalization levels.
What is the overall strategy, Saurabh, on debt? You've mentioned that you're careful on working capital, but I'm guessing because of the near-term triggers, you're going to have to be taking more on that front, shorter-term tenor. What is the overall book looking like, and what's the objective there?
Yeah, so debt levels have gone up mainly because of two reasons. Of course, one, as you mentioned, the working capital intensity in the business has increased. And secondly, we also have a big CapEx. CapEx is on expansion, on committed CapEx is under the PLI, on some of the land bank that we have recently bought for an expansion. So yes, but we still think it's pretty manageable. If I have to just give you a number broadly, what it would look like on 31st March, I think so it should be somewhere around debt to equity should be somewhere around 0.35 to 0.4. I don't see it crossing beyond that. And internally also, we are very much a debt conservative company. And and we feel that the cash flow generation is already come back, and it will be even better next year, considering things will be normal next year. And we should be able to fund a significant portion of our CapEx through our internal accruals.
Understood. Saurabh, thanks so much for joining in. Always a pleasure speaking with you, and wish you all the best.
Thank you very much. Thank you.